Let's connect then with Bhanu Chopra. He's the CEO and founder at Rategain Travels to talk about a pretty spectacular set of numbers. Thanks so much for joining in, Bhanu. To begin with, over the last 2 financial years, you've been reporting back-to-back losses. Now with the impact of unlocking having come about, the fact that people are now resuming travel, how has that aided your numbers?
As you must have seen in our earnings report as well, this year has been a tremendous year for us because the company's gone through multiple transformations, and FY22 will always be a special year in the history of Rategain, as it stands as a testament what a culture of collaboration, nurturing talent, and innovation can achieve. So if you look at our numbers, this quarter, as a result of travel bouncing back, we saw growth of 51% year on year. And even our fiscal year numbers are reported to have 46% growth. And when I talk about our adjusted PAT numbers, it was phenomenal because we registered 177.8 million in our adjusted PAT for this Q4 and 317.9 million for FY22. And these growth numbers are quite significant, as you already mentioned, from a year ago.
If we were to look at the segmental performance as well, what's it been like? Martech, distribution, and DaaS, which is your highest revenue driver?
Yeah, so on our Martech business, we saw some significant growth as a result of, also the acquisition that we did of My Hotel Shop. Now we have an end-to-end digital marketing platform that we can take to our customers. And as a result of that, we are able to offer some key differentiators as compared to our competition. We can manage and drive performance across all digital channels. We're the only platform that allows both connectivity and optimization to meta search channels, the only platform that uses demand forecasting data to provide smart insights to improve return on ad spend. So as a result of this growth, now Martech business is almost 33% of our overall revenue. And our revenue has grown about 175% year on year in this division. The distribution business also continues to grow with recurring revenues of 97% and contributed to about 38% of our overall revenue in FY22. With our volumes are actually now higher. The transactional volumes are higher than 2019 levels. And we've enabled 50 plus new connections between OTAs and the large hotel partners, which helped us in driving this growth. And this included connecting the top 5 hotel chains of the world to regional leading OTAs such as Rakuten, as well as new emerging OTAs such as Hopper in the US. That is now the fastest growing mobile first travel application in the US.
Nayantara joining here. Tell us, EBITDA margins, we need to talk about that. They were, of course, hit because of the pandemic, but as the world reopens, as you can't even get an appointment for a Schengen visa or a US visa for many, many, many weeks, and that is what's being reported worldwide too. When are your margins going to be restored?
We are actually already, as I mentioned to you, the exciting, key highlight of where we stand today is that on a run rate basis, we are already exceeding our pre-COVID annual recurring revenue by 8%, which was last achieved in FY20, which is the highest in the history of the company. And in terms of our margins, we are now at about 76%. And if you look at our adjusted EBITDA margin for the year, it's at 11.7%, which is, a growth of 66% year on year, indicating the margin expansion that we've had due to the growth of the business.
What we've seen over the last 3 to 4 years have been 3 big acquisitions. Now you're talking about a healthy P&L and going back to the pre-COVID levels, doing better than the pre-COVID as well. Inorganic growth, where does that stand? We're talking at a time when you're also seeing startups, tech companies facing tough times just because of the macros?
When we think about M&A, we are very, very clear about, going after assets that, are a part of our overall product vision and our product roadmap. So if these are capabilities that are part of our overall vision of RevMax platform, which enables our customers to acquire guests, retain them, engage them, and have a wallet share expansion. Two, we also look at some geographic penetration. So as you would have noted in the three key acquisitions that we've already done, two were in the US and one was in Europe. So it gave us a much deeper geographical footprint in these economies. And third, we are always looking at competitors as well, which can enable us to sort of get stronger in the areas that we operate and look at those in an opportunistic way.
Okay, fair enough. Looking at competitors in an opportunistic way. So I take there could be more deals in the pipeline. But moving away from that, you've been in the news of late, selected by Caesars Entertainment for providing real-time rate intelligence. That's a big deal for the company. So take us through what products they're going to be using, what was the consideration for this deal, and what are some of the other deals such as this in the pipeline?
See, one of the key differentiators for Rategain is that the fact that we have interoperability across all our products and we are able to provide one integrated tech stack. So this was around, this deal was around DaaS, but the fact that we were able to put together a lot of the products under DaaS portfolio as well as distribution, we were able to differentiate and win this deal. And what you will find in across all our product and different segments and business lines is that most of our competitors are one-trick ponies, whereas Rategain provides one integrated tech stack. So the ability to put everything together seamlessly and drive value for our customers usually ends up acting as the differentiator for us.
Fair enough. Thanks much for joining in and sharing with us the outlook. While Rategain is a little bit somber in today's trading session on the back of what's been a pretty steady quarter,